Hello, everyone, and welcome to another episode of the Property Trio. And we are talking market update, and we've got in our hot little hands February's details, which is nice because the December, January can be a little bit problematic with the seasonality, but hopefully we've got a good read on the market right as it is at the moment. And joining me, as always, my lovely co-hosts, David Johnston and Cate Bakos. Good morning.
Good, Mr.
Good morning.
Mortlock.
So, 1% national vacancy rates. That's the highlight one for me. Who would have thought we would be in this position a couple of years ago?
It's unbelievable, isn't it?
No, I've been investing since, for a long, long time now, more than half of my lifetime, and I've never seen them this tight.
Yeah, and it's only getting tighter. We'll get to vacancy rates maybe in a bit more detail later, but every capital city's vacancy rate got lower in the last month. So, yeah, except for Hobart. So, it's getting harder and harder to find a rental, and it's only going to become a bigger and bigger story, and the government can't turn on supply easily. So there's a confluence of events that are conspiring to certainly drive up rents, and I think they'll drive up property prices more than expected this year as well, which was, as we talked about before coming on air, Mike, was one of your predictions.
Oh, I'm crossing my fingers. If I come in like year one with my predictions and jag it, I'll hang my head on that. I might retire.
Yeah, I might retire too.
And it's not like Hobart's, got these blown out vacancy rates either. It might not have gone backwards, but it's still incredibly tight, isn't it?
It is.
Yeah, it's 1.3% or something. Still ridiculously low.
And isn't it interesting? We were talking about some headlines that were circling around very early this year saying, the rental crisis was easing, which was just so ridiculous because all it was Christmas was a really great distraction and people don't tend to want to move then anyway. So we did see a slight easing during that period, which is completely seasonal. And of course, it's ticked straight back up again. And when we look at rental movement, every single capital city, except for Darwin, has had an increase to its annualised rental growth rate.
And we're going off script here a little bit, but one thing that we just put some research out on is the gap between median unit rents and median house rents in our three major capital cities. And that gap has been trending closer for quite some time over the last 12 months. Normally you could get units quite a lot cheaper because people pay a premium for a house and maybe a little bit of a backyard or something, but the gap is really closing, which kind of shows that, all right, well, if houses aren't growing rapidly, it's because people are moving to units, but the whole shift is forward, right? Like people are only moving into units because of that affordability. When that gap closes, then houses and units, I think, push forward together. It's a sad state of affairs for some renters out there, but hopefully we get some intervention in the next little while that pushes things in the right direction. Let's talk the monthly data from CoreLogic. I think the story month on month for the last, as long as I can remember, is Perth leading the charge. It's up over the month and the quarter. And, of course, Brisbane and Adelaide having a great run as well. What are the standouts for you, Dave?
Yeah, look, Perth just keeps charging ahead, doesn't it? I keep harking back to Pete and me making that prediction, but just a year early that Perth was going to fly.
Still counts. Still counts.
But all the I guess parameters or factors are in place for that to happen, and it's hard to see it stopping or slowing down, isn't it? With all the data that we're looking at, so growth of 1.8%. Even faster than the previous month of 1.6%. They're big numbers. Perth's grown at 18% over the last 12 months, and that's a total return of 23.9% because it averages, that Perth averages a yield of 5.6%, which is quite high. So
it's very healthy.
Very healthy. So look, it's just flying along. Adelaide just doesn't seem to want to slow down either, growing at 1.1% again. Brisbane actually just ticked back a little bit, still very strong at 0.9%, back from 1%. But it feels like other cities are now getting on the bandwagon. Canberra jumped up from being a negative to plus zero point 0.7 for the month. Sydney jumped from 0.2 to zero point 0.5. And even Melbourne went into positive territory after being in negative territory for the last 3 months. So, I feel like it's this month's set of data is a real signal that I think property prices are going to be stronger than I expected and nearly everyone expected this year, except for possibly you, Mike.
Well, do you know what? I started the year, and January is a really tough month, particularly in an auction-centric city like Melbourne, because not much happens in January. But I could already tell that things were a little bit different. The market felt a bit more energetic, and buyer participation's been really strong. And we'll get to this, but if you look at the listing numbers, and then you have a look at the performance that's been cited here for February, which I would argue is old because data lag really is an issue when we're looking at these monthly figures. I was expecting it to be even stronger for Feb. And I said to myself, well, that's data lag. We'll see a really strong result for March. And I'm going to predict that now. We will see, certainly my city, which I'm active in and at the coalface in, I think Melbourne will show us what it's doing in the next round of data. But I'm really surprised that we've had so much listing activity. And if you look at listing numbers and sales numbers, there's a lot going on. When I saw the early indicators, and that comes in the form of appraisal activity, and happily CoreLogic captures that because agents generate CMAs, and that is all captured, and that rate of CMA generation is really peaked. And I thought to myself, with all of this listing activity, we're going to see prices contract because I don't think that demand will meet supply. Anyway, I've been wrong. Buyers have come back as quickly as vendors have. We've just got much higher listing volumes, more sales activity, better quality stock as well. I'm working with clients and we've got properties to choose from, which is really great. So I think that this data is only the start of it. Lag is always something that impacts the monthly data.
Yeah, well, that's interesting to hear. So we'll look forward to the Melbourne figures and them pushing along. And for anyone playing at home, the CMAs are really where agents will run a report to give them some comparables. So they normally will do that prior to moving into a listing presentation or something like that. So a really good indicator of some coming listings. But yeah, interesting to hear that there's been so many coming on, but they're just getting hoovered up by the demand. The buyers are out there, right?
They sure are. And the other one for me, the standout here I also noted was combined capitals versus combined regionals. And I hate the word combined because there's so many markets within this envelope of properties, but they've both met each other for this month, 0.6 and 0.6, which is pretty startling when you consider how much the regions contracted after the lockdowns eased.
And on total return, Cate, that's something that you flagged as well, that typically you're getting higher yields in the region. But what's your read on that?
Yeah, so the interesting thing is if we just look at the annualised capital growth for combined capitals versus combined regions, it's 10% for the caps and 5.5% for the regions. But then when we look at the annualised total return, which also takes into account rent, it's 13.9 versus 10.1. So that ratio is very different. And it just goes to show one of the key reasons that a lot of investors go into regions is because they get a bigger total return in a lot of cases. And rents are generally stronger in the regions. And the fact that we've got really tight vacancies across the board, there's a lot of reasons and rationale for looking at good regional performers. I'm very pro regions for the right budget and for the right expectations.
And those figures show a bit of underperformance from regions, but if you look at the rolling 3 month change in dwelling values, capitals versus regions, it's regionals at 1.3% and combined capitals at 1.2%. The capitals had a noticeable blip in the last couple of months, but they're kind of come back to parity now. So I guess we've talked a lot about the COVID impact and people buggering off to the regions, and then the CEO sort of saying, "Get back to your desk." That seems to have. Would we say that that's all kind of settled down now? Whoever's in the city is staying in the city, and whoever's in the regions is probably staying in the regions?
I think we've got a bit of equilibrium now. Yeah.
Yeah, and I think it's too early to call overall, but certainly we're getting back to a period where regions are moving lockstep with the capital cities again, aren't we? Over the
Yeah.
last sort of, at least the last quarter.
Yep. And looking at 3-month change in dwelling values, it's quite a similar story with Perth, Adelaide, and Brisbane at the top at 5.2, 3.6, and 2.9 respectively. We got Sydney sitting at 0.6 and Melbourne at negative 0.6. And that's Kate's big tip that Melbourne is going to turn around. We actually can see on that graph, which hopefully you can see in the show notes, a little bit of it's almost like a reverse tick. We can see those green shoots with Melbourne. But before we move on, I want to ask a question about Melbourne, because Melbourne has probably suffered the most from state intervention in housing markets that I can think of. And it's not just the land tax stuff. I mean, land tax, we had that pop up in Queensland and it was repealed before it actually came into effect. Yet still, people were making decisions like it was going to happen because it was legislation. We saw an impact from that. It's a little bit too early for me personally to share some of the data that we have, but anecdotally it's pointing to a reduction in people purchasing in Victoria. And we even had one particular national buyers agent say, "I'm not playing in Victoria anymore because everything's gone in the toilet with the minimum standards and the state intervention." You can't keep a good state down for too long. I'm aware who I'm talking to. I've got two proud Melburnians here, right? Do we see it as being the bottom of the cycle and all that sentiment is kind of just washed through?
Yeah, I think 2023 was our dark year, and it was tough for a lot of people, but we have got investor activity in Melbourne, which is surprising for many, and in part it surprised me a little bit. But all of my investors are either from interstate, majority Sydney, or a few expats that are based overseas. So investment is alive and well. It's just in a bit of a different format now, and I'm seeing a lot of local investors looking at other states.
Dave, you'd like to zero in on things like the median value differentials. If you look at Sydney, 1.12, Melbourne, 778, is that making you kind of think, look, there's kind of like an elastic band effect where Sydney is going to pull Melbourne along, or is it a bit more nuanced than that?
Look, it's more nuanced, but you do have to take the macro and the micro, and people watch these things, and there is herd mentality when there's investing. And once a location looks affordable enough, people flock to it. And that's going to happen. It's just a matter of when it will happen, with obviously Brisbane and Canberra challenging Melbourne's median prices. Affordability obviously drives property decision making, and if a place becomes significantly affordable, that elasticity starts to come into play, and people will move to that location. I mean, we've sort of seen the opposite of that in Hobart over the last 2 years, where it became sort of, for such a small population of circa, I think, 150,000 or so. We had friends of ours from Hobart at our place last night. Actually, we're talking about the population, so that's why I know it off the top of my head.
We love it when you quote friends and family members on this show, Dave.
Yeah. So I mean, we've seen that with Hobart, where people have gone, okay, look, this is a bit frothy, as you say, Mike, and in Hobart, and I think that's held it back. And I think that's going to see a run for Melbourne. Whether it's this year or next year, I couldn't say. But I also think what's happening is people can see rates. It's pretty clear rates are going to start coming down later in the year. We've just had highest migration on record. We have an undersupply of property. We have rents growing at the fastest rate, almost on record in the lowest vacancy rates. There's all these reasons to get back into property. And this month's data highlights that. Then you've got people looking to buy property and they can see sales from 2 years ago and that are more expensive than they're having to pay for properties today. And that's because 5 of the 8 capital cities are still below their median peaks, the cyclical highs of 2022. So a lot of people are seeing affordability as well. So I think that's all playing out, and that's why I'm more convinced we're on the beginning of a very strong run in the capital cities that haven't been flying like Perth, Brisbane and Adelaide have been.
And we're at, a quarter of a decade highs in wages growth after stagnant growth for a long time. So there is a bit more affordability. It's hard to say things like that when the median price is still over $1 million in Sydney, but they've come down off the peak and there's a bit more affordability. Kate, you're very active in some of the regions in Victoria, and 2023 for me was a story of affordability. The affordable locations really saw the lion's share of investment. With this Melbourne turnaround, are you seeing it straight away in the cities, or will it come the regions first, or is it a bit like sort of places that I'm used to, the major centres come first and then the regions will follow?
It's a good question, Mike. I'm getting price points as a common conversation. And some people will say, look, I'm really excited about spending, I'm excited about getting into investing, but I really want the capital city. I don't want the region. So some people will just block it out. Whereas others will say, I've got this price point, could I only get an apartment? And I'll say to them, well, no, if you're happy to travel afar, you could get a house for that budget. And in cities like Ballarat, you could get a house secured. I didn't buy it. My clients bought it. I secured a $675,000 double-fronted Victorian in really nice condition. It had been semi-updated, good newish kitchen, beautiful house in one of the best streets in one of the best suburbs. So anyone who knows Ballarat, I bought in Soldiers Hill. Stunning property. Unfortunately, it transacted over the lockdown period for 720, and they'd since done some work on it. So that was a contraction, and it was obviously a bit of a cool negotiating effort on my part as well. But for $675, you couldn't get a good 2-bedroom apartment in the leafy inner east for that.
Yeah,
but you can do it in Ballarat, and the rents are reasonably good. The interesting thing about the regions is because Melbourne has played catch up so energetically with rent, our rental yield differential isn't too different now between our city and the regions. It's still different, but it's back in the day when I was buying in Ballarat 14 years ago, I could get a 6% gross rental yield. Well, you won't get that in Ballarat now, not unless you buy a real shocker.
Yeah. What are you getting, 4.5? Something like
about that.
Yeah, okay.
Yeah, for a house.
Interesting. That sounds like an absolute Jaffa. I'm going to send you a text just to make sure you've still got my number.
What I've noticed though, you asked about people's appetite and which areas for investors will take off. It's actually price points, and you said it before. The lion's share of purchasing activity is at lower price points because borrowing capacity is bitten, holding costs have been biting, and of course things like land tax are on everyone's minds. So I'm not seeing too many investors saying, buy me something for 1.5 or for $2 million. I'm seeing a lot of investors saying, what could I get for 450, 500, 600, 700? That is probably the sweet spot of investing at the moment. That's circa 700. And a lot of people should take the time to understand what 700 buys you in Melbourne versus what it buys you in another capital city versus what it gets in the regions, and then have a look at your rates of return as well.
Our data in 2023 said the average purchase price across all resi investors was $650K. So, I mean, that probably goes to show where people are at. And, if you want to play in some quality areas in Melbourne, even the regions, you probably need a little bit more than that. But then, there's all parts of the country that people have been finding properties well under that. Dave, vacancy rates. We talked a little bit about it at the open. I mean, if this isn't crisis levels of rental accommodation, I don't know what is. I mean, I guess in some respects, we're advocating for the investors. This is property investing podcast after all, but most investors that I know actually kind of aren't real comfortable about how tough it is for tenants right now.
Yeah, so as we touched on, vacancy rates reduced again in the last month, and we don't see that changing in the short term, which means yields continue to rise at a rapid rate. I noticed in Western Australia, they've actually made it easier for developers to build new units. So they've set up new planning laws, which come in effect this month. And just for our listeners, to remind them that Perth has the lowest percentage of units as a portion of all properties of all the capital cities. So only about 16% of the properties in Perth are units. So it, probably more than any city, needs more units built. And obviously they've got the fastest rate of property value growth. So they're allowing developers to circumvent local governments with development applications. And instead they can apply to an independent panel to assess multi-level developments which are worth more than 2 million. So basically, it means the local councils can't stymie these investments, these developments. For application projects valued at 20 million or more in Perth and over 5 million in regional areas, they can be lodged directly to the Planning Commission for determination. So even the bigger ones can even bypass independent panels. So I think, I talked about this in this year's predictions, I think we're going to see more of those types of policies put in place to bring on supply across the country. And the WA government obviously enjoyed our episode on WA, Mike.
Yeah, I reckon.
They've been the first to pull the trigger on something like that.
Yeah. Case of wine would have been nice from them, but anyway, as long as they're listening, I think it's a good move, right? We need supply. We've been talking about supply for a long time, but it does beg the question: what's going on at the LGA level, where the developers are hitting their heads against resistance? I mean, it's great to go around it and get things done, but it sort of requires an investigation as to what's going on. That this legislation needs to be created, right?
I would be very nervous about developers having carte blanche with medium and high density development in my backyard.
Yeah, well, it's not carte blanche. They just go somewhere else outside of the council to get approval.
Yes. Yeah.
Yeah, but I mean, no one knows the backyard like that local council. So, it's a balance.
It's a balance. I think life's a big pendulum. It swings too far one way and then you got to swing it back the other way.
It should be in politics.
Yeah, I know. And, sometimes it feels like that pendulum is just being shoved by a mass of people, and then it goes the other way and we went too far. Like, do we need 20 people to push it? Yeah. But anyway, that's the world we live in.
Well, look at Perth, though. Back to vacancy rates. I look at the number of houses that are actually available right now, or number of properties in the entire capital city for the month of Feb. There were 776 available properties. That's hardcore.
Yeah. It's such a small number, isn't it?
It is.
Yeah, you can guarantee that there are more families and more individuals looking than that number. Cate, listings. That I think is, apart from vacancy rates, that's the big story right now. We're seeing it a little bit in the data, but you're seeing it more so on the ground. Talk us through this stock coming on and why it's not putting downward pressure on prices.
Yeah, great question. Unfortunately, we haven't got charts to point to. We usually do. For whatever reason, the CoreLogic monthly chart packs aren't including listing numbers at the moment. So there's a blip there. We haven't had them for 3 months now. But what we are seeing is sales volumes. And sales volumes are not a great reflection of listing, because listing is obviously the properties that are still for sale and on the market now, whereas sales volumes are the properties that have sold. And we've got one of our biggest auction weekends across the board coming up on the 23rd. And then we're going straight into Easter break and school holidays. So everyone who wanted to sell prior to Easter has got an auction on the 23rd. And I'm having agents left, right, and centre saying to me, "We'll sell it prior if you like, make an offer." So it's an overwhelming period at the moment, and our listing numbers are greater than the last 5-year average by quite a margin. And we do have buyers that are soaking them up. I think that initial piece of news that we had at the beginning of the year, when our inflation figure was lower than expected, that gave rise to a lot of claims that we could anticipate rate cuts. And even though we're not getting a rate cut and the banks aren't necessarily saying we're about to have one, people are now putting two and two together and deciding that there could be a rate cut this year. In fact, there should be a rate cut this year. That's what the common consensus is. It's not necessarily my consensus, but if you remember the crazy highs of 2021 when everything was just going gangbusters and FOMO was out there everywhere, that's still fresh on people's minds. It's only 3 years ago. And they're saying to themselves, I'm not letting that happen to me again. So we've seen a lot of people on the front foot jumping in. And of course, stock levels are higher. There's more stuff to choose from and there's more quality properties out there. Vendors have renewed confidence that they'll get decent results. And hence, that's where we're at the moment. What will be interesting is what happens after Easter, because I know we've had a lot of volumes pushed from last year into early this year. We do still have quite a few after Easter, but if we've got a tight stock winter, we could see prices go crazy again then as well, because prices tend to go nuts when we've got insufficient supply and everybody's scrambling with confidence.
Particularly if we have first rate reduction in winter as well.
Or if we talk about it. We only need to talk about rate increases and people go crazy.
We're already talking about it too, aren't we?
Yeah. Well, maybe if we have that mega spring selling season, it looks like we're going to have, then it'll purge some of those potential listings that won't pop up in winter. Who knows? Time will tell. But yeah, the data that we've got is January, and the monthly change is down across the board, but it's not necessarily a reliable one. But if you look at the yearly percentages, it's down in Brisbane, Perth and Adelaide, and up pretty much everywhere else, and up by 24.4% in Canberra, which I think, lends itself to the numbers that we're seeing from Canberra. It's been kind of in the doldrums for a while.
Surprisingly, it rebounded this month with the positive growth of 0.7%.
Yeah.
Despite those numbers.
Yeah.
It is frustrating not having listing numbers. I hope CoreLogic reinstate that. So if anyone is listening, we really want the listing numbers.
Yeah.
And I really enjoy seeing the leading indicators with agent CMA generation. If we can see more appraisal activity, we'll get a better compass for understanding listing volumes in coming months.
The bottle of wine that the West Australian government owe us, we'll send half of that on to you guys at CoreLogic if we can get that data, because we've got to take a clip of the ticket.
Yeah.
Rental yields. Are we ready to move on to rental yields?
Yeah, for sure.
Absolutely.
Dave.
Well, the growth in rental values has also re-accelerated through early 2024. So no surprises with vacancy rates continuing to fall. Auction clearance rates in terms of the overall market have been stronger than expected. So the monthly pace of change for Feb was 0.9%, which is the highest reading in rental growth for the last 11 months. So remember, it had started sort of tapering rental growth. Well, it's starting to pick up again by the looks of it. So it's getting a second lease of life. So the rolling quarterly change in rents was 2.4%, which is the highest since May last year for a rolling quarter. We're really seeing what was beginning to be a little bit of a plateauing of rental growth, just changing direction again and starting to increase and become more expensive for tenants and better returns for investors, mindful that the average yield is still only in line with about the decade average. So the relativity of rents to value of property is in line with what it's been for a long time.
Yeah. But do we think rents might do better this year from a percentage growth term than capital growth?
Is better the right word?
More go up.
Yeah. Yeah, will rents increase, and will the increase in rent eclipse the increase in capital growth?
Yeah.
Not in
This
every
is why.
capital city.
No,
This
look,
is
Melbourne's certainly gone bananas. We've been back to front. We've had 11.8% growth for houses over a year in terms of rents. We certainly haven't had that in capital growth. Like I've said, though, it's kind of like a DNA strand. You know how they go up
Yeah.
broadly at the same time, but not in sync. I think we will have a few cities have rental growth eclipse capital growth. I really do.
Yeah.
But I think if we
Melbourne
poll all
was
of
likely
them,
to be
it'd
one of them.
probably come out on parity as an
Yeah.
average across everything.
Yeah. Yeah, I think so. I'm just trying to think of the predictions that I'm going to hang myself on when we record next year. But I think I said that rental growth will increase, but not at the pace at 2023, because I believe formation rates will change. I think the empty bedrooms will start being taken up, and people will change their behaviour to try and circumvent the pressure. But all the pressure is go up, right?
I feel like vacancy rates just continuing to get low. It's going to be hard for formation rates to outstrip
To keep up.
to keep
I agree.
up. Yeah.
And we've had record net migration. And I'm going to go out on a limb here and say I'll disagree with you, Mike. I think that 2024 won't be softer in terms of rental increase than 2023.
All right.
Yeah. I might go on that limb too with you, Kate.
Now I'm being bullied.
Yeah, you'll be shouting all the rounds at the pub
Yeah,
if we're right.
Fair enough. If I could only figure out whether to call them pots or pints, I've still got no idea.
What do you call them?
Well, there's schooners and pints.
We've
There's no pot.
transitioned. Yeah. We don't drink pots much anymore. They've sort of gone out of vogue. When I was it, yeah.
Pints.
So-
Everyone wants a pint now.
Pint or schooners nowadays. We've become more like New South Wales.
Thank God for that.
Oh, so sad.
Consumer sentiment. We don't really have much to share on that one, do we? Because we're sort of talking similar data to the previous month.
Yeah,
Well,
well,
it hasn't
managed.
come out, the one we normally refer to, but Kate's found another consumer sentiment release.
Yeah,
Oh,
the Roy
beautiful.
Morgan consumer sentiment. I like the fact that we stick to the one chart because comparison is really easy when you do that. But in the absence of Westpac being ready to go, Roy Morgan it is. ANZ Roy Morgan consumer confidence was down 2.2 points to 81 this week, the lowest the indicator has been all year. The index has now spent a record 57 straight weeks below the mark of 85. Consumer confidence is now 1.1 points above the same week a year ago, but 2.3 points below the 2024 weekly average of 83.3. So that's a lot of data for us. But I went straight down to toys. Time to buy a major household item, and I was troubled yet again. Buying intentions were virtually unchanged this week, with 21% up 1 point. 1 percentage point of Australians saying now is a good time to buy major household items, while 50%, up 2 percentage points, now say it's a bad time to buy. I really prefer the format of Westpac, just saying, but it was good to
so
have
do I.
this information to chat about in today's session.
Yeah. Seems like everyone's a little bit depressed with cost of living pressures, and it'd be interesting to see the results of this Coles and Woolies investigation. When do we expect any outcome of that?
Did you see the Four Corners run of that?
I didn't. Is it already
It was
done?
cool.
I've got to
They had
catch up.
some interviews. It was great. Yeah.
Yeah.
Oh, the famous one.
CEO
with
got up and
Brad
walked off.
Douchey.
Oh,
Yeah.
yes, I heard about that. Yeah.
And then he
Not
fell on his
funny,
sword
though.
a couple of weeks later.
Yeah.
Yes, there's potentially some price gouging and predatory behaviour.
That's
Who
right.
would have thought from the two mega giants of Australian household perishables? Anyway, I shouldn't be too cynical. Dave, talk to us about loan commitments. What story is that telling?
Look, one thing I do know that's happening is there's becoming a bit of a rate war going on again. So it's a good time to be looking to refinance or renegotiate your mortgage. So the banks are starting to price more competitively on their interest rates. So that's something that our listeners should be aware of. CBA in particular pulled back from strong pricing for a number of months, but they're also now back in the game. In terms of the new loan commitments in January, housing overall fell by 3.9%, and owner occupiers fell by 4.6%, investors only 2.6%. Yeah, they're nothing major to take out from that. I mean, it says it's seasonally adjusted, so it says less people were looking to borrow to purchase. So purchaser numbers had slightly fallen, but look, it really is only January, which we know can be a pretty inactive month.
Yeah. It is a shame that our government portal is so late with the data lag. It's a frustration for us each time, isn't it?
It is.
Yeah, all right. So the other half of that case we'll give to the government if they can get their portal sorted. Yeah. Although I remember that story of somebody did an audit of the wine cellars at the Prime Minister's house in Kirribilli, and the amount of Grange that was there. It doesn't sound like the government needs any help. Anyway,
there was a lot of Grange there.
Yeah, apparently.
I thought you were going to say there's a lot of Grange missing.
Is this Turnbull's era, though?
Oh, I think it might have even been pre-Turnbull. And Turnbull's probably, he didn't even stay there. He stayed at home. Yeah. That's when you know you've got money, when your place is way better
1,000%.
than the place we give the Prime Minister.
Yeah, it was just his overflow cellar.
Yeah. You can imagine him going down to the cellar and going, Grange? I wouldn't wash my driveway with it. I liked him, but, he's old money. All right, unemployment and wage price index. Correlation. Surprised?
Yeah.
No, I'm guessing. Cate?
No correlation. Yeah, of course there is.
Mm. So what are we talking, the unemployment rate?
Jumped to 4.1 from 3.9. Yeah, okay. So I think we're beginning the steady rise of unemployment.
But again, this is still dating back to Jan, which is annoying.
Yeah, we don't have February's numbers yet. But still, look, historically extremely low rates of unemployment.
Yeah. And if you look at the wage price index, it's it's worth checking out the show notes or joining us on YouTube if you can't see it, because I'm putting it on the screen right now, and it's that little I'm doing that back to front, so that's awkward. Yes. But it's an absolute ski jump.
And again, this is still Jan, but yeah, the correlation is quite intriguing. And the worry here is that we had our governor talk about, our Reserve Bank governor, that is, talk about the need or the identification of having a negative impact on employment in order to keep the health of the economy where they want to keep it. And the idea of enforcing job losses to keep things humming sounds really awful. But having said that, we are still looking pretty healthy in terms of unemployment.
Yeah, it does sound a little bit horrifying when people use things like human capital to describe people. And Mr. Gurner had a hard time with journalists telling some harsh truths in probably not the softest way about, we need unemployment to skyrocket to have capacity to do what we need to do. But yeah, that's the unfortunate elephant in the room. Before we move on to the gold nuggets, is there anything that stood out for you guys in terms of other data for the month?
No, I think that we've covered most of the key elements from my perspective.
Dave, I wanted to ask you about the 3-year bond curve.
Yeah, so it's certainly the predictions are looking, and the money markets are expecting 2 rate reductions. Yeah. I think they're sort of like at 40 basis points over the next, the 1 year bond yield. So, expecting, or actually I think that's by like the end of this year so it's looking more likely there'll be 2 rate reductions by the end of the year in terms of the money markets. And then the 3-year bond curve. What's it saying?
It's just ticked down a fraction. It's just below 3.6.
Yeah. So,
In fact, both the 10-year and the 3-year have ticked down just very recently.
yeah. So that's expecting 3 rate reductions to be the average mark for us, where we'll sit on average over the next 3 years.
Yeah. But even 10 years, they're remarkably close, aren't they? 3.96, and that's just slightly under as well. They're only showing, even with a 10-year forecast, a couple of rate cuts still.
Yeah, I saw one of the leading investment managers for, I think, BlackRock, talking that she thinks rates will go down for initially, but then they'll come back up. And we're in, where rates are sitting now, give or take, is where she sees rates being for the longer term. And there's also a risk that they could end up higher in this new sort of, I guess, dynamic with where rates are likely to be, so over the longer term. So it's interesting that 10-year yield is sitting at 4%.
As soon as you had said higher, I was very threatened to cut your microphone. We're not ready for that sort of talk just yet.
I think it's important, though, that people understand that 2% was never a long-term interest rate that we could expect. That was emergency rates during COVID.
Yeah, and the RBA were at pains to say in the meeting, not an interest rate hike, but returning to more historical levels. And they've been saying that ad nauseum, so that's a good point. All right.
I'm trying to think of the reason she said that as well. So it's an ageing population with lots of wealth that they'll be spending across, and this is sort of a worldwide phenomenon. Geopolitical instability, the transition to clean energy, all being inflationary factors that'll cause rates to be higher for longer, even though we're about to have some rate reductions probably this year and next year.
Yeah, interesting. All right, it's time for our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
Vacancy rates. We've got unprecedented tight vacancies, certainly in my investing lifetime. So this gold nugget is for any prospective tenants out there. You've got to be able to differentiate yourself. So being ready, being prepped, being prompt, having a cover letter, have your referees on there, have a bit of information about yourself, and make sure that you've had good conduct in any other properties that you've rented, and you've been able to cite the property managers that a future property manager can talk to, because getting ahead of the curve is really, really difficult in this space. But if you can differentiate yourself, remember, in a lot of cases, the person that's meeting at the door will have an influence on the leasing manager's selection when they're going through the prospective tenants for each property.
Yeah, absolutely critical point. It's so difficult out there. You've got to put your best foot forward. Dave?
Look, I just think this month in particular suggests that so many of the data points are pointing towards a stronger than expected capital growth side of things, or property price rebound this year. So if you are considering buying property this year, whether it's a home or an investment property, I suggest getting your ducks in a row and sitting down with your strategic mortgage broker, getting your pre-approval in place, and really starting to narrow in on your property strategy, location and price point, because I don't think there's going to be too many places in the country where property prices are getting any cheaper this year.
Absolutely. Couldn't agree with you more, Dave. I think if you can, get involved now, because you might regret it. Anyway, that's been the February market update. Thank you very much, guys, and we'll see you next week.
See you next week.
Next week.
Bye.